Welcome to Iron Financial. This is where we forge stronger portfolios by cutting right through all the market weakness and noise. And today, we are putting Monday.com squarely under the hammer.
And when you say under the hammer, you mean it got absolutely demolished, right? I mean, they just dropped their Q4 earnings, and if you just glance at the surface, everything looked pretty solid. But the market's reaction? A complete and total demolition. Look, this isn't just a stock taking a little bit of a hit. This is a high-flying growth story getting shattered into a million pieces, and we're going to break down every single one of them for you.
A demolition, that might be putting it lightly. We are talking about a company that, by all the usual accounts, did exactly what it was supposed to do. They beat on the top line, revenue. They beat on the bottom line, earnings. So you have to explain this to me. How in the world does that translate into a 22% collapse in one single trading day? That's not a pullback. That's not profit-taking. That's a full-blown panic. What on earth is the market seeing that isn't sitting right there in these headline numbers? What are we missing here? Okay, let's lay a solid foundation here with the numbers that everyone saw first. You have to start with the top line, with revenue. As you can see right here, for the fourth quarter, Monday.com pulled in $334 million. Now that is a 25% increase year over year. You have to put that in context. In this kind of economic environment, for a company of this scale, that is a strong, healthy, robust growth number. This is precisely the kind of solid construction that should build confidence, not completely shatter it. And that strength, it doesn't just stop at the top line. It continues when you drill down to the bottom line. Let's talk about profitability, because that's what really matters. Adjusted earnings per share, or EPS, came in at $1.04. Now, the so-called experts on Wall Street, the analysts, they were only expecting 92 cents. So let's be crystal clear. This isn't just a small beat. It's a significant, double-digit beat on earnings. This is the very definition of over-delivery, the kind of thing the market is supposed to reward handsomely. More revenue, more profit. It's straight out of the textbook for what a solid quarter is supposed to look like. Rewards? You call this a reward? A nearly 22% haircut in a single day? This right here, this is the brutal, cold, hard reality of the situation. All that supposedly good news you just laid out, all that strength and revenue and earnings, it was completely incinerated. It went up in smoke. Something in the very foundation of this company is clearly deeply cracked. And the headline numbers just aren't telling the whole story. This kind of violent, vicious reaction tells me that the entire narrative around this company has fundamentally changed, shaking investor confidence right down to its core. Exactly. And so today, we're going to deconstruct this entire situation with the precision of a structural engineer. Here's our agenda for this deep dive. First, we'll look at how a solid beat somehow became an absolute bloodbath. Second, we're going to expose the cracks in the armor, the things hiding just beneath the surface. Third, and this is crucial, we'll zero in on the guidance, because that is the real story. Fourth, we'll analyze the bull case, this idea of forging an enterprise fortress. Fifth, we'll look at management's reaction, putting them on the defensive. And finally, we will deliver the iron verdict. All right, let's get right to work. Section 1, a beat becomes a bloodbath. To even begin to understand the collapse, we first have to fully appreciate the strength of the numbers they actually reported. It's critical. We need to deconstruct this good news to establish a proper baseline so we can really understand why the market's reaction was so incredibly severe, so seemingly out of proportion. Now, just look at this table. It's clean, it's simple, it's totally unambiguous. This wasn't some kind of mixed quarter with some good and some bad. No, this was a clear, decisive win on the two metrics that matter most to investors. You can see it right there. Q4 revenue hitting nearly $334 million, beating the street's consensus by over $4 million. And right below that, the adjusted EPS at $1.04, absolutely crushing the 92-cent estimate by 13%. By any objective measure you want to use, this is a strong, powerful report. The company performed, and they performed well. And of course you had management taking a victory lap. Of course they were. I mean, listen to this quote from the co-CEOs. "We delivered another year of strong, disciplined execution." I mean, it all sounds great, doesn't it? They're using all the right buzzwords, strong, disciplined. But here's my question. If the execution was so strong and the numbers were so undeniably good, why did investors run for the exits like the entire building was on fire? Something just doesn't add up. Because the building is showing stress fractures. And that brings us right to section 2, the cracks in the armor. You see, to understand a crash like this, you have to look beneath the surface. You have to get past that fresh coat of paint they put on with the headline numbers and actually examine the structural integrity of the business. And folks, that is where the problems really start to appear. And this slide right here illustrates the first major problem, the net dollar retention rate, or NDR. Now, for anyone who's not familiar, NDR is an absolutely critical health metric for any subscription business. Think of it this way. If you have 100 customers all paying you $100 each today, NDR tells you how much those very same 100 customers will be paying you a year from now. Anything over 100% means they're spending more with you. They're upgrading, adding seats, buying more products. It's the engine of organic growth. And if you look at the trend here, well, it's not good. Across the board, overall, for their larger customers with 10+ users, and even for their prized $50,000 and up customers, it's ticking down. Look, it's not a catastrophic collapse, but it's a persistent grinding erosion. It's a slow leak. The expansion engine is clearly losing steam. And that is not the only area of decay we're seeing. Let's dig into the unit economics. This is the core machinery of the business itself. As you can see on this slide, the free cash flow margin dropped by a staggering 10.1 percentage points year over year. That is a massive, massive hit to the company's efficiency. And right below that, you see the customer acquisition cost, or CAC, payback period. In simple terms, that's how long it takes to earn back the money you spent to get a new customer. Well, that has jumped by 4.2 months. The bottom line here is unavoidable. It is getting more expensive, and it's taking significantly longer to build the business. That is a serious, undeniable drag on the entire growth formula. Which brings us to the main event. This is the catalyst for the crash. We're at Section 3, Guidance, the Real Story. You always have to remember, the market is a forward-looking machine. It cares less about where you've been and more about where you're going. And the future that Monday.com painted for investors, well, it is not the high-growth blue sky picture that they all signed up for. This is where the real damage was done. Now, I need you to really focus on the slide because this is where the entire story turns ugly. Take a look at the full year 2026 guidance. Management is telling the market to expect revenue somewhere between $1.452 and $1.462 billion. As you can see, Wall Street was expecting $1.48 billion. That's a clear miss. But the real poison, the real reason for the panic, is in the growth rate right below it. They are guiding to just 18 to 19% growth for the coming year. Now remember, they just finished a year of 27% growth. This is not a slowdown. This is a massive deceleration. The high growth narrative that was justifying a premium valuation for the stock just got completely shattered. And what's the excuse? What's the reason they give for this absolutely catastrophic guidance? Well, management blames conservative assumptions around SMB demand and macro conditions. But let's be real here for a second. Is this just management being prudent and cautious? Or is this a quiet backdoor admission that their core SMB business, the very engine that built this entire company, is fundamentally broken? They use these soft words like choppiness and volatility. To me, that sounds like corporate speak for the foundation is crumbling and we have absolutely no idea when or even if it will stabilize. Okay, to be fair, let's look at the other side of the coin. While the SMB foundation is undeniably shaky, they are actively trying to build a new, stronger structure on top of it. And this brings us to Section 4, Forging an Enterprise Fortress. This is the bull case. This is the argument that Monday.com is successfully pivoting away from being just a high-volume SMB player to becoming a high-value, durable enterprise titan. And this slide right here is the absolute core of that bull case. As you can see from this chart, customers who are spending over $50,000 a year with them now account for a massive 41% of their entire annual recurring revenue. Just think about that. That's up from just 36% only a year ago. This is a significant structural shift in their revenue mix. They are successfully moving up market, anchoring their business to larger, more stable, and more predictable enterprise clients. And the momentum here, it's just undeniable. You can't argue with these numbers. Look at the growth in these high-value customer cohorts on this bar chart. The number of customers spending over $50,000 a year grew by 34% year over year. And even more impressive, the cohort of customers spending over $100,000 grew by a stunning 45%. This is hard proof that their upmarket strategy is actually working. They are successfully landing and expanding with bigger, more resilient clients. All right, you know what? I have to concede this point. A 91% gross retention rate for these large enterprise customers,
That is rock solid. You can't poke holes in that. That's an absolutely elite number in the software world. It shows that the product is incredibly sticky once it gets embedded deep inside a large organization. So, okay, fine. The enterprise product is a fortress. But a fortress is completely useless if the generals who are leading the army have lost their nerve.
Which brings us to what I believe is the most damning part of this entire story. Section 5, Management on the Defensive. For me, this is the single biggest red flag of them all. This goes way beyond just numbers on a spreadsheet. This is a full-blown crisis of confidence that starts at the very top, and it's what truly, deeply spooked the market.
Now, to really understand this collapse in confidence, you have to rewind the clock just one quarter, just 3 short months. This is a quote from the Q3 2025 earnings call. The CFO's response to a question about their long-term targets was firm. It was confident. He said, "We said that we are going to be $1.8 billion by fiscal year 27, and we are committed to achieving this number." I want you to pay very close attention to that word on the slide, committed. That's not a suggestion. That's a promise.
Now let's fast forward just 90 days to this most recent call. The same CFO is asked about the very same target. And the response this time? You can see it right here. The 2027 number is currently off the table. Off the table. Let that sink in. They went from being committed to off the table in 90 days. That is a stunning, credibility-shattering reversal. How can you possibly trust a management team that loses that much visibility into its own business in a single quarter? He is exactly right. For the market, this is a 5-alarm fire. This is the biggest red flag you can wave. When a company abruptly withdraws its long-term targets like this, it signals the ultimate uncertainty. It's management telling investors, we have lost our compass, we don't know where we're going, and if they don't have a clear view of the road ahead, how can the market possibly have one? This isn't just about weak guidance for 1 year. This is a total loss of the entire long-term narrative. It is a massive, fundamental breach of trust between the company and its investors. Okay, let's bring this all together. We have seen the good, we have seen the bad, and we've definitely seen the ugly. This brings us to our final section, the iron verdict.
So after this brutal, punishing sell-off, what is Monday.com? Is it an incredible opportunity to buy a great company at a deep discount? Or is it a classic value trap with a lot more pain still to come?
The crucial decision point here is balancing the two competing narratives you see on this slide. On one hand, you have the forge. That's the powerful bull case. The enterprise business is strong, no doubt, now making up 41% of ARR and growing very rapidly. That high-end retention is a fortress at 91%, and let's not forget, the company is still profitable, it's still generating cash, and its new AI products are seeing rapid adoption. That's a powerful foundation for the future. But on the other hand, you have the fracture, and the bear case is just as compelling, if not more so. The disastrous guidance for 2026 signals a massive growth deceleration that you can't ignore. The withdrawal of long-term targets has absolutely shattered management's credibility. That persistent choppiness in their core SMB market is a problem they openly admit won't get better this year. And finally, you have those worsening unit economics, which prove it's getting harder and more expensive to grow. That is a long and very, very worrying list of structural damage. Which leaves us with the ultimate question we have to grapple with. After a 22% demolition, is Monday.com a fallen fortress just waiting to be rebuilt on a new, stronger, more durable enterprise foundation? Or is the foundation itself fundamentally and perhaps irreparably cracked, with the deep-seated issues in the SMB business and the complete crisis in management confidence being just too much to overcome? Right now, the market has voted emphatically that the foundation is cracked. The question for you, as an investor, is whether you believe they have the tools, the strategy, and most importantly, the leadership to forge a new one from the rubble.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.